Welcome to Daily Bread Podcast. My name is Aaron Smith. I am a wealth manager, financial planner, 32 years of experience. This podcast is about everything money. It's also for individuals who are higher degreed and you're earning between $150,000 and $500,000 per year. That's right. I'm talking to you high income earners. It's important that as we navigate our financial lives, that we make sure that we position ourselves to be successful financially. Why are we having this conversation? We're having this conversation because, look here, uh, many of you are not where you want to be financially in your life. I know that. And there are many reasons. You don't have to be embarrassed by it. That's first of all. Number one, you don't have to be embarrassed by it. Second, the reason why you're not where you want to be financially is because you never were taught the strategies that were necessary for you to build onto your net worth. I know that your net worth, as you say it, doesn't equal your income and your education level. Many of you saying, I feel uncomfortable, embarrassed, ashamed, or ashamed of myself because my net worth doesn't match my education level and my income. That's why you want to tune into Daily Bread. What we're going to do is we're going to educate you so that you can get to where you want to be financially in your life. And you have to start right now. Doesn't matter your age. Look here, I'm always excited about sharing strategies that allow you to build on your personal wealth. This conversation that we're going to have this evening, we're going to talk about life insurance. That's right. We're going to talk about you, the high income earner. What type of life insurance you should own in your house? That's only two types. One is term insurance. The other is what we call cash value. That's only two. There are variations of the two, but there's only two. And many times, you, the high income earner, you're choosing the wrong type. And we're going to talk about that. First of all, let's talk about where does life insurance come from? It comes from being offered by an insurance company. There's an insurance company that offers you life insurance where you pay a premium in the event of your premature death. It pays a claim to your beneficiary. That's ideally the foundation of life insurance. But that's not all what life insurance is. Life insurance can be used to help you maximize your wealth while you're living. Now, let me share this with you. This is important. Life insurance companies, they're in business to make money. Their goal is to pay less claims that they possibly can pay, but continue to receive your premiums. Life insurance takes your premiums and they invest those premiums into bonds. When they invest these dollars, they earn a rate of return on their money, right? So they're making a rate of return on the dollars that you're putting into the contract. But once again, actuaries, these are people who understand numbers. They work from a large numbers perspective. And they already know that based on your good health, because you have to be in good health to be approved for life insurance, they know how many people are going to die at a certain period in the future. So they already know that they only have to pay 2% claims on term life insurance. What does that basically mean? It means that if you purchase a term life insurance policy, the likelihood of it paying a claim to a named beneficiary that you have named is likely never going to happen. It does happen, but likely never going to happen. So let's talk about it. High income earner, high degreed income earner. Let's talk about life insurance this evening. And let's talk about how you use it. And let's talk about why it's important for you to have the right type. The right type is important for you so that you can build wealth to the next generation. Aaron, why are you talking to us high income earners? I'm talking to the high income earners because you, the high income earners, have the ability to leave tremendous wealth to the next generation and the next generation. But many of you don't know how to execute it, or you're not willing to execute it, or you're simply choosing the wrong strategies. So let's talk about these. When we talk about life insurance, I generally describe it in whether you rent it or whether you own it. You could actually rent or own. So let's talk about rent first. Rent. Rent is term insurance. What is term insurance, Aaron? Term insurance comes in different forms. It comes in 1 year term or a 5, 10, 20, or even a 30-year term. That means that you put a premium in every month, or you put a premium in every year. And assuming you have a 20-year term, it means that that premium stays the same. It doesn't increase. It doesn't decrease. It's in every month the same amount for 20 years. And if you lose your life, your beneficiary receives what they call a death benefit based on your gender, your health, your age. That's how they determine what your premium is going to be on a term policy. They also determine your premium based on how many years you want the term for. The shorter the number of years of term, the least expensive the policy. Now, let's talk about this. This is important because many of us never really get into this and understand it. But one type of insurance that is important to note that you should have, if you're a high income earner, you should have, let me turn some light on here. You should have a term policy on yourself with your employer if you are employed. If you are employed, you should purchase the additional amount of coverage that's allowed to you with your company. What your company typically does, they give you a one-time base salary generally. So if you're making $190,000 a year, you get a base $190,000 policy. That policy is generally paid by the company. Not always, but generally. And the premiums are really inexpensive because of two reasons. And I hope that you have something to write with, something to write on as I'm sharing with you. There are two reasons why the premium is cheap. One is a group policy. There are a group of people in that brings the premium down. The other reason is it's a 1 year annual renewable term. For every year that you work for the company, they renew your coverage. Why isn't Aaron only a 1 year renewable term? Because you may decide to relocate from that company to another company in the future. Or that company may have a layoff and they don't want to pay for term coverage for more years than one. So it's an annual renewable term, is group, and it's inexpensive. They give you a base amount generally that they pay for, but you may have to pay for it. But even if you pay for it, it's minimum cost. However, if you are working for a company and they allow you to have the ability to purchase 2 times, 3 times, 4 times, 5 times your salary, high income earners, you should purchase as much coverage that's allowed with that annual renewable term because it's inexpensive. Now, here's where it gets really interesting is that what I see a lot over the years that I've been practicing financial planning, offering and coaching financial planning, what I find is high income earners tend to purchase term insurance because it's cheap. Let me say that again. You high income earners tend to purchase the term life insurance because it's cheap. And as Aaron said before, only 2% of the policies ever pay out. So at 30 years old, at 40 years old, at 50 years old, you purchase a term policy. The actuaries already know, once again, if you are going to no longer be here. How do they know, Aaron? Because they work on the law of large numbers, and the actuaries know. So what you do is you purchase this term policy at 40. You purchase a 20-year term. Remember, the premium's going to stay the same for 20 years. After 20 years, now that you're 60 years old, because one thing about planning, you have to be able to see in the future. You have to anticipate what your financial life would look like in the future. You have to anticipate, you have to visualize what are you going to be doing 20 years later? How are you going to be financially successful or better 20 years later? What goals are going to be important to you 20 years later? And what happens is we get to the 20 years and you've been paying this low premium for 20 years and you're healthy now. You're healthy, or you're not healthy. You're not dead, but you're healthy or not healthy. And you get to the 20-year mark and you say, I want to continue to have this life insurance. And the insurance company says, we are going to force you to get rid of it. See, because you started off 20 years ago saying you just want a 20-year term. So what we're going to do now is we're going to 1,000% up above what you're paying in the 21st year. So in the 21st year, it's going to be 3,000% more expensive. In the 32nd year, the 22nd year, it's going to be more expensive. In the 23rd, in the 24th, in the 25th. But because it's going to be so expensive, why is it more expensive? Because they're trying to get you out of the policy. They're trying to get you to cancel the policy. And you will cancel it. Trust me. You're going to cancel because the premiums are going to be so expensive that you're going to say, no, I can't do that. I don't want to do that. And unfortunately, many times as we get older, our health doesn't always agree with us. And you're going to want more coverage. You want to keep the same coverage. And you're going to be stuck because you're wanting to go additional year on the 20-year term that you agreed to. You want to go 21 years, 23 years, 25 years. So those premiums are going to creep up every year. Remember, 3,000% increase in the 21st year, assuming you purchase a 20-year term. And you're going to say, no, that's not what I want to do. You're going to cancel the policy. I'm going to go somewhere with this in a second. This is important. It's very important because in my experience, almost 95%, almost 95% of the individuals I sit down with when their term policy is about to expire, they want to keep it. And they are shocked when they see what the new premium is going to be. Remember, insurance companies are in business to make money. They don't want to pay claims. They know that you're 20 years older. They want to get you out of the policy. They've already won financially. They don't want to be at risk of you going more than that 20 years that you purchased and they having to pay out a claim. But that's a term policy. And most of you are buying term policies This is, once again, this is outside of your employer. With your employer, buy as much coverage as you possibly can buy in a term. But when you're outside of your employer, meaning on the commercial market, you don't want to purchase a term. That's right. You don't want to purchase a term policy. You're not going to benefit from the term policy. You're not going to win with a term policy. But what you were sold or what you were told is that the term works because it's inexpensive, it's cheaper. That's what's also advertised to you. You ever heard of an advertisement saying something like this? You are 25 years old and you want to have life insurance and you know that you can pay $15 a month and we can give you 2 million of coverage. That's a term policy. Okay. Insurance companies already know, once again, that likely of paying a claim is likely not going to happen. All right, so let's take it a little bit deeper. That's as simplistic as I can explain it as a term policy. Now, if you, once again, are tuning in and you're a high income earner, and you're interested in life insurance, you must opt for a permanent policy. That's right. You must opt for a permanent policy. Aaron, what is a permanent policy? A permanent policy is a term policy plus cash value. It does two things. It's term plus cash. It makes it permanent because you're putting more money in the policy in the early years and throughout. It makes it permanent through your life expectancy. You win. Or let me just say it this way. You win and or your beneficiaries win on a permanent policy. Well, what are some permanent policies? There could be whole life. There could be universal life. There could be index universal life, right? These are what we call permanent policies. That means that you put money in and the policy lasts for your lifespan. That means that the insurance company has to pay out 100% as long as you're paying the premiums, 100% of that policy is going to be received by someone that you love. That you love. So when you are thinking about purchasing a term policy, don't think about the 20 years. Don't think about the low premium. Don't get fooled by that. Let me step back for a second. And let me say this. As we have these conversations on Daily Bread, what Aaron wants to do is Aaron wants you to connect all of the dots. We're going to talk about strategic planning when it comes to insurance, life insurance, health insurance, homeowners and automobile insurance, how you win with these things. Aaron wants to talk about stocks and bonds. Aaron wants to talk about how your 401k and your IRAs work, how to maximize from these IRAs and these Roth IRAs. Aaron wants to talk about estate planning, how you strategically plan wealth to the next generation, next generation, next generation. Aaron wants to talk about how you strategically work an amortization schedule, how you're able to reduce your debt, maximize the reduction of your debt in the most efficient way. Aaron wants to talk about entrepreneurship, how you use entrepreneurship from a tax benefit, from a wealth built benefit, and how you're able to pass your businesses on to your kids. This is the conversation. This can't be done with low income earners, ideally. It can be done with you, the high income earner. However, what I am seeing is that you, the high income earner, you are investing, you are planning, you strategically planning like a low income worker, like a low income earner. So what we want to do in these Daily Bread conversations, we want to change your mindset. We want your mindset set. We want you to be able to position yourself so that when you stop working, that you're able to live that best life. We want you, while you're working, to be able to live that best life. We want you to give your kids and your grandkids a head start, an unfair advantage, an unfair advantage. Listen to me. Listen to me, high income earners. A high income earner should be able to give their kids and grandkids an unfair advantage. That's what's happening every day in this country. Unfair advantages are being offered because strategically, we're putting our best foot forward when we're doing financial advice. So that's what we're talking about. So the second type of life insurance for individual is permanent coverage. Permanent coverage, again, it's nothing more than a term policy and cash value, meaning that when you put the premium in, the premium is higher that you put in. It's more expensive. It's not whether term is better than whole life or permanent or universal life. That's not the question, y'all. Don't get fooled by that. I'm telling you right now, cash value life insurance is better for. Why you can say that, Aaron? I could say it because I've been doing this for 32 years. I've been doing holistic planning for 32 years. I know how the wealthy win. They don't win with term policies. Let me go further. Why would I do a permanent policy, Aaron? The obvious reason that you would do a permanent policy, the obvious reason is because it leaves a death benefit to a loved one. In other words, the premiums that you put in over the years, you can't outlive those premiums. And a death benefit is going to go to a loved one. Let me give you an example. Let's say you're putting $500 a month in. You've been putting it in every single month, $6,000 a year. You've been putting it in for 30 years. 30 years. You've been dropping this money in here, right? Well, at worst, there's going to be a 500, 1 million, 2 million death benefit that's going to go to somebody. You didn't lose any money. It went to somebody else, your family members. You giving them a head start. Now we talk about the different conversations. We're going to talk about how you use that life insurance and how you put it into trust and so forth to maximize wealth from your children to your grandchildren to your great grandchildren. That's for another conversation. But first of all, the conversation is I got coverage for the rest of my life. That's the least that the policy does. But you know, when you have a cash value policy, it can do more things than that. Let me share with you. Here's some. One of them is you can finance your children's college education. You can build cash value up in the policy, and that policy money can be borrowed out. Borrowed out means that you don't have to pay it back like you would with a traditional bank. You can borrow the money out. You can pay for your children's education, and it doesn't count against any financial aid because it's coming from a life insurance policy. So you can use cash value for life insurance for college education. Oh, forget the fact that we talked about the death benefit. Take that off the table for a second. Once again, that's minimum that it does. You can provide a college education, supplement a college education using life insurance, cash value. You could also purchase a second home. You can use the cash value to purchase a second home. You might be looking for a rental property. You may be looking for Airbnb property. You might be property out in the country. Well, you can use the cash value as down payment which is generally required 20% minimums. Today, they're even trying to get up to 30% that you need on these properties that's outside your primary property. You could use the cash value from your policy. You can pay off your debt. You can use cash value life insurance policy to create a debt strategy, debt snowball, or a debt avalanche to be able to pay your debt off much quicker. You can see the amortization schedule on your mortgage or your student loans come down dramatically quicker by using a cash value life insurance policy. Mm-hmm. That's right. That's right. See, the cash in the policy, that money that you're putting in, a larger portion of those premiums, it earns a rate of return in the policy. In many cases, the rate of return is a guaranteed rate of return. And that rate of return is a compounding. There are multiple reasons you can take cash out of your policy. If you decide to pay it back, it's just going to reduce from the death benefit that you have. That's going to go to your beneficiaries income tax free. You can overfund a cash value policy, which would be overfund, Aaron. That policy may be costing you, for example, $500 a month. And you might say, you know what? I want to put $1,000 a month in it. And that policy is earning cash, is growing, and is grown. You're now 20, 25, 30 years in the future, and you're ready to use that to supplement your retirement. You could have income coming out tax free, just like a Roth IRA. You don't have to pay taxes on it. It's coming to supplement your retirement income. A cash value policy is powerful. You might decide that you want to establish a business. For y'all entrepreneurs, business owners, you may already have a business. You want to establish a business. You might want to use it as leverage with your banker to create more line of credit. Your banker will give you a higher line of credit if they secure your life insurance contract. Mm-hmm. Because you have a nice amount of cash value and it's a permanent policy. Oh man, wealth building is fun. I love it. It's so many ways that you can create strategies, but you can't do it with a term policy. And your high income earners are opting for these term policies because it's cheap. You're paying for it because it's cheap and you're not getting any benefits out of it. And a lot of reasons why you opt for the cheap is because you're not an investor. Life insurance is an investment, you all, akin to the other investments that you own. Life insurance is an investment as well. Mhm. That's right. That's right. With good credit and cash value in your policies, with a death benefit that you can have as what collateral to the bank. The bank will lend you money, will give you a line of credit. And you can take that line of credit and grow your business. See, as we're having these conversations, life insurance is nothing more than a tool that you can use when you're no longer here for your family, but you also can maximize life insurance while you're living. That's right, while you're living. Let me tell you another reason why you want to have life insurance. Cash value. High income earners, many of you work for companies that have pensions and you're married and you're making a decision to take your monthly pension. However, your monthly pension gives you two options. It gives you a single life benefit, it gives you a joint life benefit. Aaron, I want to make sure that my spouse receives this monthly benefit in the event that I prematurely decease him or her. So what you do is you take that benefit that was like 5,000 a month, single life, you reduced it down to 4,000 a month with joint life, because I want to cover two lives. Mhm. And what happens is when I reduce my benefit by $1,000 a month or $12,000 a year, if I predecease, and I'm the employee, if I predecease my spouse, my wife, she gets a $4,000 benefit for the rest of her life. Here's the problem. What if she predeceases me? See, if she predeceases me, I cannot go back to that $5,000 a month pension. I'm stuck with $4,000 a month for the rest of my life. Oh, but if I had a cash value life insurance policy, that life insurance policy has a death benefit that replaces, that takes in place of that survivorship for my wife. And I can now continue to take the higher 5,000 a month benefit. High income earners, you want to have a cash value life insurance policy. And you want to have a term policy only on your job. Now, before I close up this evening, if you're an entrepreneur, and I'm going to talk my next podcast, it's going to be for life insurance for business owners. All right, man, y'all got some fantastic things you can do as a business owner. But the bottom line, if you're a business owner, in other words, you're not an employee, what you want to do is a combination. You can do a combo. You can do a combo term for this amount, and you can do a combo term permanent for this amount. You can do a combo coverage. You can do both, and you can do them at the same time. So, ladies and gentlemen, I want to thank you for tuning in. This is Daily Bread. I'm Aaron Smith. Uh, just to share with you, I will continue every week to have these podcasts. Hopefully, I can do them more. I do currently right now 20-second, 30-second short videos every single day. Daily Bread. Every single day. These shorts are special because they allow you to think about things that you can do to help you build wealth. There's an opportunity right now in this country that's never been had before. Whenever there is disruption, whenever there is fear and concern in our economic economy, in our country, that is the time to get wealthy. That's the time to get rich. I'm here to share with you. If you take some of my strategies and ideas and you execute, you implement these. And matter of fact, I would advise you not to try to implement and execute them yourself. I recommend that you pay a qualified wealth manager to help you execute these. It could be somebody in your local town. Or you can reach out to our firm. Our team will help you. God bless you. We look forward to talking to you next time. See you now.